Welcome to the lecture on corporate accounting. In this lecture, we will discuss about issue of share, forfeiture of share, and reissue of forfeited shares. The meaning of shares, share capital, types of shares, types of share capital, accounting entries for issue of shares, oversubscription, undersubscription of shares, how company can issue shares, how a public company can issue share, how private limited company can issue shares, various concepts related to shares such as right issue, bonus issue, employee stock option scheme, etc. Accounting entries in case of forfeiture of shares and accounting entries in case of reissue of forfeited shares. So let's start with issue of shares first. In issue of shares, we will discuss about shares capital, types of share capital, meaning and definition of shares, types of shares, accounting treatment of share capital in company's balance sheet. We will provide journal entries also, and we will prepare final account of company also. So let's start with introduction to company accounting. As we know, previously there were sole trading concern and partnership firm were there. In sole trading concern, number of member allowed is 1. In partnership firm, minimum 2 partners are required and maximum 50 partners are allowed as per Companies Act 2013. There were less capital in case of sole trading concern, and there were more capital as compared to sole trading concern in partnership firm. So number of owners in case of sole trading concern, only one member is there. Therefore, it is called as sole trading concern. Sole means single, and trading concern means business organization. So, a business organization in which only one person is the owner, manager, and controller is called as sole trading concern. And in case of partnership firm, minimum two member is allowed. Minimum two member is required to form a partnership business, and maximum 50 members are allowed. Similarly, capital in case of sole trading concern is lower because only one person brings capital into the business. Therefore, the capital amount is lower. But in case of partnership firm, many people comes together to run a business. Therefore, all the partners will bring capital into the business. So there will be higher capital as compared to sole trading concern. But due to industrial revolution, the requirement emerged to run a business organization on a larger scale. So company form of organization came into existence, and there are n number of members allowed in company form of business. It means there are thousands and lakhs of members available in case of company form of business organization, specifically public limited company. Hence, the overall capital will be larger as compared to any other type of business organization, such as sole trading, partnership, Hindu undivided family, and cooperative society, etc. Even the liability of owners in case of sole trading concern is unlimited. In case of partnership business, the partner's liabilities is also unlimited. But in case of company, the liability of the owners is limited. This is the important feature in company form of business organization. The members do not require to bring personal money into the business to pay off the liabilities. The member is not required to sell off their personal property. In case of company's asset is not enough to pay off the liability, then member is not required to sell their personal property and bring into the business. And the members is called as sole trader in case of sole trading business, partners in case of partnership business, and shareholders in case of company form of business organization. In company, the owners are called as shareholders. Now, let's start with the term share capital. In case of sole trading concern and partnership business organization, the investment into the business is called as capital. But in case of company form of organization, the investment made into the business is called as share capital. And share capital is raised by issue of shares. So, share capital is money invested into the company by issue of shares. Now, let's find out what are the types of share capital. First type is authorized capital. Authorized share capital. It is also called as registered capital or nominal capital. This authorized capital is the maximum number of shares which a company can issue to raise the fund during the lifetime of the company. It is recorded in Article of Association as well as Memorandum of Association. The authorized share capital details should be mentioned in AOA and MOA. Also, they have to file MOA and AOA with Registrar of Companies. It is the maximum number of shares which a company can issue to the general public during lifetime of the company. The company can increase or decrease authorized share capital by making modification in Article of Association and Memorandum of Association, but special resolution is to be passed in special meeting and all the legal procedures are to be followed and all the provisions are to be satisfied. So, authorized share capital is maximum number of shares a company can issue to general public during lifetime of the company. It is written in AOA and MOA. It is also called as registered capital or nominal capital. Next is issued capital. Issued capital is the part of authorized share capital which are issued to general public to raise capital, and remaining capital is called as unissued capital. For example, authorized share capital is 1 lakh shares, and out of 1 lakh shares, 80,000 shares are issued by company. Then maximum number of shares is 1 lakh, that is authorized share capital, and 80,000 shares is issued capital which are issued by company. Next, subscribed capital. The number of shares which general public has accepted and subscribed is called as subscribed capital. Fourth, called up capital. The face value of share can be 1 rupee or 10 rupee, but whole amount cannot be raised by company at one time. The company can raise the fund by demanding call money after certain period of time as per requirement. So the amount of face value which are called upon by the company is called as called up capital, and remaining balance which are not yet called up by the company is called as uncalled capital. Next, paid up capital. For example, the face value of the share is 10 rupees and 7 rupees is called up, so 3 rupees is uncalled capital. But out of total number of shares which are issued and subscribed, if 200 shares on 200 shares, 2 rupees out of 7 rupees is not yet paid by the subscriber, then it is called as unpaid capital, and remaining amount is called as paid up capital. The amount of money which are paid up by the investors is called as paid up capital. This is the part of called up capital. And the amount which are called up by the company but not paid by the subscriber is called as unpaid capital or call in arrears. So this is the amount which are not paid by investors or subscriber. Even there may be a case where the investor can pay the money in advance. In that case, it is called as call in advance. So paid up capital is a part of called up capital. Called up capital is a part of subscribed capital. Subscribed capital is a part of issued capital, and issued capital is a part of authorized share capital. So we can present in this way: authorized share capital can be classified into issued capital and unissued capital. Issued capital can be further classified into subscribed capital and unsubscribed capital. Subscribed capital can be classified into called up capital and uncalled capital. This amount of money will be demanded by company during lifetime of the company, and called up capital can be further classified into paid up capital and unpaid capital. Unpaid capital is called as call in arrears, and there is one more term, call in advance, and some of the money will be reserved for future purpose. So it is called as reserved capital. So types of share capital: authorized share capital, it is also called as nominal capital and registered capital. It is registered in article of association, memorandum of association, and registrar of company. This is the maximum number of shares which a company can issue to the general public during lifetime of the company. For example, authorized share capital is 10 lakh number of shares and face value is 10 rupees. Number of shares 10 lakh, face value 10 rupees. This is the authorized share capital. So company can issue maximum 10 lakh shares. Next, authorized share capital can be further divided into issued and unissued capital. If company issues 8 lakh shares out of this 10 lakh shares, then it is called as issued capital, and remaining shares is called as unissued capital, that is 2 lakh shares. Issued capital is the portion of authorized share capital which is issued to general public, and this unissued portion of capital will be issued during lifetime of company anytime whenever money requires. Now, issued capital can be further classified into subscribed capital and unsubscribed capital. It means if company issues share to the general public, it is not necessary that 100% shares will be accepted by general public. For example, 8 lakh shares is issued by company and 7 lakh 90,000 shares are accepted, then it is called as subscribed capital, and balancing figure is called as unsubscribed capital, that is 10,000 number of shares. Now remember, it is necessary to subscribe 90% of share capital which is issued by company to continue the issuance. If the general public accepts less than 90% of shares, then company has to cancel the issue and refund the amount of application money. Now, out of subscribed capital of face value 10 rupees, company can call up 7 rupees at a time, and balancing 3 rupee will be demanded whenever need arise. So whole 10 rupees face value may not be called upon at a time. So the amount of face value which is called up by the company is called as called up capital, and the amount which is not yet called up by the company is called as uncalled capital, that is 3 rupees. If company issues 8 lakh capital and public accepts 8 lakh capital, public subscribe for 100% capital, that is 8 lakh shares. So it is called as full subscription. If company issues 8 lakh shares and general public accepts 7 lakh 90,000 shares, then it is called as under subscription. And if company issues 8 lakh shares and general public provides application for more than 8 lakh shares, then it is called as oversubscription. Journal entry in each cases will be different. Now, out of this 10 lakh, 7 rupees is called up by the company, so it is called as called up capital, and remaining amount is called as uncalled capital. But it is not necessary that 100% applicant will pay the amount. Out of 7 lakh 90,000 shares and 7 rupees called up, one shareholder holding 500 shares have not paid 2 rupees out of called up money, so it is called as unpaid capital. On 500 shares, 2 rupees is unpaid, that is called in arrears. And if one shareholder having 50 shares have paid these 3 rupees in advance, then it is called as call in advance. So we have discussed meaning of share capital, types of share capital. Now let's discuss meaning of shares and types of shares. As per Companies Act 2013, section 2 subsection 84 provides definition of shares as a share is the share in a capital of the company and includes stock as well. So this definition states that whatever the amount of investment into the company is done, that is overall investment. We call it as share capital, and part of share capital, each unit of share capital is called as share. The smallest unit of share capital is called as share. So if total amount of investment is 10 crore and face value of one share is 10 rupees, then this one share, this one part is called as share. This 10 rupees of face value each is called as share. So share is the share in the capital of the company. A part of this capital, the smallest unit, is called as share and includes stock as well. So in simple terms, stock is the bundle of shares. Collectively, shares are called as stock. So share market is also called as stock market. Now let's discuss the features of shares. First part, it represents the ownership of a company. The owner of the shares is called as shareholder of the company. Second, return on investment. The person who purchases the share is called as shareholder and they get dividend as a return on investment. Dividend is a part of profit which is distributed among shareholders. Therefore, it is called as dividend. The part of profit of a company is distributed, divided among shareholders, and remaining balance will be reinvested into the business for future expansion. Next, each share has distinctive number which is provided in share certificate. So, for example, share number 1, 2, 3, 4, 5, n number of shares are there. For example, I have 500 shares from distinctive number 1,20,001 to 1,20,500. So, in share certificate, it will be mentioned that name of the company, name of the shareholder, face value of shares, number of shares held by shareholder, and distinct number of shares from which number to which serial number the shareholders have purchased the shares, along with common seal and authorized signatory. So share certificate shows the distinct number of shares. Next, it is the evidence of title. Title means ownership. How come we know that the particular person is a shareholder of the company? So this is the evidence. On this share certificate, the name of shareholder is present. Some years ago, there were physical shares. Now all the physical shares are dematerialized in electronic forms. Fifth point, value of shares. The value of shares can be face value, issue value, and market value of shares. Face value means the price of each shares. Issue value is the price at which company issues share to the general public. For example, if the face value is 10 rupees and it is issued by company to the general public at 15 rupees, then it is called as issue value. Issue value can be more than face value or equal to face value. It can also be less than face value. But as per Companies Act, new provisions have come. No company can issue shares at discount, that is less than face value. Now, company can issue share at face value or more than face value. So it is called as issue of share at par. It means face value is 10 rupees and issue value is also 10 rupees. So it is called as issue of share at par value. Issue of share at premium. It means face value of share is 10 rupees, but it is issued to the general public at 15 rupees. So 5 rupees is premium. Issue value is more than face value. So issue of share at premium. And issue of share at discount. It means 10 rupees face value issued at 8 rupees or 9 rupees. So if issue value is less than face value, it is called as issue of share at discount. But as per government rule, company cannot issue share at discount. But in the question you may ask to provide journal entry of issue of share at discount. Now, what are the rights of shareholders? Shareholders have right to get a dividend. Shareholders have right to attend meeting. They have right to give vote. They have voting rights. They have right to access books of accounts and get a photocopy of books of accounts of any years. So there are two types of shares: equity share and preference share. And equity shares can be further classified into equity share with normal voting rights and equity share with differential voting rights. Preference share can be further divided into cumulative preference share and non-cumulative preference share, participatory preference share and non-participating preference share, convertible preference share, non-convertible preference share, redeemable preference share and irredeemable preference share. So first let's discuss the meaning of equity share and preference share. Then we will discuss in detail types of equity shares and types of preference shares. So equity shares, which is also called as ordinary shares, is the type of share which is not preference share. Equity shares are those shares which are not preference share. It means the shareholders of equity shares have no preference in two cases: at the time of payment of dividend and at the time of repayment of capital. Equity shares are those shares which are not preferential shares. So, equity shareholders do not have preference at the time of payment of dividend and at the time of repayment of capital. Repayment of capital during winding up of the company. When company is liquidated, that is winding up, the payment will be made to all the outsiders liability and preferential shareholders, and the balancing figure will be provided to equity shareholders. Therefore, the equity shareholders is also called as residual claimant. The person who claims the money at the end. The remaining part of money will be provided to equity shareholders. So remember, they do not have preference in two cases. At the time of payment of dividend every year, they will be provided dividend after paying the dividend to preference shareholders. And second, at the time of repayment of capital at the time of winding up of the company. The money of shares will be refunded to equity shareholders after paying off the liabilities and preference shareholder money. The remaining amount will be paid off. So equity shareholders is also called as residual claimant, and equity share is also called as ordinary shares. Generally, equity shares are traded in the stock market. So based on the meaning, we can provide some features of equity shares. First feature is permanent capital. The equity share capital is a permanent in nature. It can be only paid off at the time of winding up of the company. Next point, fluctuating dividend. The equity shareholders get dividend at fluctuating rate depending upon the part of profit. If company earns more profit, equity shareholder may get more dividend. If company earns less profit, company the shareholders will get less dividend. If company earns no profit, shareholders may not get any dividend. And if company suffers loss, then also the equity shareholders will not get any dividend. So equity shareholders get fluctuating rate of dividend depending upon the profit of the company. If profit of company is more in a particular year, the shareholders will get more dividend. If company earns less profit in a year, then shareholders will get lesser proportion of dividend. And if company have no profit, no dividend will be provided to equity shareholders. And if company suffers loss, then also no dividend will be distributed among equity shareholders. And the rate of dividend will be different in each year. Similarly, risk reward is high. The risk reward ratio is also high in case of equity shareholders because there is high risk and high reward. Equity shareholder may not get any dividend if company is not having any profit or it is in loss. So there is a risk, high risk, and reward is also high. If company earns huge profit, then company the shareholders will get huge amount of dividend. Next, rights. Equity shareholders have right to participate in meeting. They have voting rights. One share equal to one vote. If a person have 5 number of shares, then his vote will be counted as 5. And if a person have 1 lakh number of shares, then his share will be counted as 1 lakh number of vote. He has right to attend meeting, right to provide vote in the meeting, right to get dividend, right to access books of accounts, but they do not have preferential rights. It means they have no preference at the time of payment of dividend and at the time of repayment of capital. Next, face value and market value. Equity shares have face value. It also have market value because equity shares can be traded in share market. If the face value is 10 rupees, but this share is traded in the stock exchange at 5,000 rupees, then it is a market value of shares. Next, they get capital appreciation. Along with dividend, they get capital appreciation. It means the market price of a share goes on increasing if company earns good profit. They can get bonus share and right issue of share. If company issues bonus share to the equity shareholders, then only equity shareholders have right to get bonus. Preference shareholders do not have right to get bonus shares. Equity shares issued by company to existing shareholders at zero cost, free of cost. Also, they are entitled to get right issue of shares. It means the unissued shares issued by company after certain period of time to the general public, but before providing share to general public, the company may ask the existing shareholders to subscribe for right issue, and right issue is issued by company at discounted rate, at lesser rate than market value. Now let's discuss about types of equity shares. There are two types of equity shares: equity shares with normal voting rights and equity share with differential voting rights. In case of normal voting rights, the voting right of equity shareholder is in proportion to his holding. It means one share equals to one vote. Normal voting right. If a person has 50 shares, then his vote in the meeting will be counted as 50. And with differential voting rights, the voting right is provided in rule number 4 of company's rule, share capital and debenture. Company's rule 2014. So there are two types of equity shares: equity shares with normal voting right and with differential voting rights. Generally, on the stock market, equity shares with normal voting rights are issued. Now let's discuss preference shares. As the name suggests, preference shares are those shares who enjoy preference in two cases: at the time of payment of dividend and at the time of repayment of capital. Preference shareholders get preference at the time of payment of dividend every year, and they get preference at the time of repayment of their capital at the time of winding up of the company. Whatever company earns profit after deducting all the expenses and taxes, the dividend, the portion of dividend will be provided to preference shareholders first, and remaining balance will be distributed among equity shareholders. So dividend is a part of profit. If company earns profit, a portion of the profit will be distributed among shareholders. First, it is distributed among preference shareholders, and the remaining balance will be distributed among equity shareholders. And the remaining amount, which is not yet distributed as dividend, the remaining part of profit is reinvested into the business. Now, what are the features of preference shares? First feature is fixed return. Preference shareholders get fixed rate of dividend every year. For example, 10% preference shares are issued to shareholders, then the 10% of face value. If face value is 100 rupees, then 10% of 100 rupees, that is 10 rupees per share, will be distributed to preference shareholders per share. So return is fixed, unlike equity shareholder. In case of equity shares, more dividend will be paid if company earns more profit, less dividend paid if company earns less profit, and no dividend in case of no profit. But in case of preference shares, company if company earns more profit or less profit or no profit, company has to pay dividend at fixed rate. Second, nature of capital. Equity share capital is permanent capital, but preference share is not permanent. It is temporary capital, because after a certain period of time, our preference shares will be converted into equity shares. Next, value of preference shares. Face value, issue value, and market value. Preference shares do not have issue value and market value because preference shares are not traded in stock market. Preference share only have face value, that is, for example, 100 rupees, and dividend will be paid on face value only. Risk. Preference shareholder have less risk. If company earns more profit or less profit, it doesn't matter. Preference shareholders will get constant return, that is fixed rate of return. If company earns no profit or company suffers loss, only in that cases preference shareholders will not get dividend. So they have lesser risk and lesser return. Next, right issue and bonus issue. Preference shareholders will not get any type of right issue or bonus issue. These issues are only for equity shareholders. Only equity shareholders get right issue and bonus issue. Preference shareholders have no right in right issue and bonus issue. And preference shareholders are those type of investors which are conservative in nature. Conservative means they do not indulge in risky investment. They they will get lesser return but safe return. They want safety of capital. So these are the features of preference shares. Now let's discuss types of preference shares. First, cumulative preference shares and non-cumulative preference shares. Cumulative means to get accumulated. If company does not earn profit in particular year or company suffers loss in that year, preference shareholders will not get any dividend, but dividend of that particular year will be accumulated to next year, and company will pay the dividend of that year along with dividend of current year. It means, for example, year 1, year 2, year 3, if company earns profit, then preference shareholder get dividend. If in the year 2 company does not earn profit, then dividend of that particular year will be accumulated and will be payable in next year. If next year company earn profit, then in that year company will pay that year dividend along with previous year dividend. So the dividend of preference shareholders get accumulated if company does not earn dividend in particular year, and it will be payable in the year in which company earns sufficient profit. So in case of cumulative preference share, the dividend of preference shareholders get accumulated and payable in the year in which company earns sufficient profit. Non-cumulative preference share, it means if company does not earn profit in particular year, that is year 2, no dividend will be paid for that year. If company earns profit in third year, then only preference shareholder will get dividend for third year only. They will not get dividend for previous year. So cumulative preference share and non-cumulative preference share. Cumulative preference shareholders get dividend and accumulate the dividend if company earns no profit, and it is payable in the year in which company earns sufficient profit. Non-cumulative preference shares are those shares on which dividends are not accumulated, are not paid in the year in which the company does not earn sufficient profit. And if company earns profit later on, only that year dividend will be distributed among preference shareholders in case of non-cumulative preference shares. Next, participating and non-participating preference shares. Participating means participation in excessive profit. It means if company earns profit, first it will be distributed among preference shareholders, then the remaining amount will be distributed among equity shareholders. But in case company earns huge profit or excessive profit in that year, after paying off dividend to preference share and equity shareholders, there is remaining profit still available in the company. Then the balance amount will be distributed among preference shareholder again. That is called as participating preference shares. Preference shareholders get participated in the excessive profit of the company after paying off dividend to equity shareholders. And non-participating preference share, in which preference shareholders do not get excessive dividend if company earns huge profit. Next, convertible preference shares and non-convertible preference shares. If preference shares get converted into equity shares after certain period of time, is called as convertible preference shares. And if preference shares are not converted into equity shares after certain period, is called as non-convertible preference shares. So generally preference shares are temporary shares. The preference shareholders get either repayment of the capital or they get equity share in exchange of the preference shares. So if preference shareholders get equity shares, then it is called as convertible preference shares. So convertible preference shares are those shares which are converted into equity shares after a certain period of time, and non-convertible preference shares are those shares which do not get converted into equity shares after a certain period, but they get their capital in return. And last, fourth point, redeemable preference shares and irredeemable preference shares. Redeemable means repayable. Redeemable preference shares are those shares which are repayable after a certain period of time. That is, the company will buy back the preference shares and repay the amount of investment. So, redeemable preference shares are repayable after a certain period of time. Irredeemable preference shares are those shares which are not repayable after certain period of time. So there are four types of preference shares: cumulative, non-cumulative, participating, non-participating, convertible, non-convertible, and redeemable, irredeemable. Remember, company cannot issue non-convertible preference share as per Companies Act. And even if no information is given in the question or in ordinary case, the preference shares are cumulative preference shares, non-participating preference shares, convertible preference shares, and redeemable preference shares. So we have discussed meaning of capital, meaning of share capital, types of share capital, meaning of shares, types of shares, meaning of equity shares, types of equity shares, meaning of preference shares, types of preference shares. So, based on the features of equity shares and preference shares, let's discuss difference between equity shares and preference shares. First point, meaning equity shareholders do not have preference at the time of payment of dividend and repayment of capital in case of winding up of the company. Preference shareholders get preference at the time of payment of dividend and at the time of payment of repayment of capital in case of winding up of the company. Second, return. Equity shareholders get fluctuating rate of dividend and preference shareholders get fixed rate of dividend. Next, risk and return. Equity shareholders have high risk and high return. Preference shareholders have less risk and less return. Therefore, the nature of investor is aggressive. Equity shareholders are aggressive investors. They take chance. They get risk, high risk. And preference shareholders are conservative investors. They they play safe. They want safety of capital and safety of investment. They get less dividend but constant dividend. They do not take chance. Next, voting right. Equity shareholders have voting right in the meeting. Preference shareholders do not have voting right. Next, right issue and bonus issue. Equity shareholders will get right issue and bonus issue if company declares right and bonus issue, and preference shareholders cannot get right issue and bonus issue. Next, capital appreciation. The capital of equity shareholders appreciated and preference shareholders capital is not appreciated. They get repayment of capital in case of redeemable preference share, only the amount of investment they get, but equity shareholders get capital appreciation because the shares are traded on stock exchange and the market value of share goes on increasing. So equity shareholders get capital appreciation, but preference shareholder do not get capital appreciation. Similarly, face value, market value. Equity shareholders have face value of 1 rupee or even 10 rupee, but flat preference shares have flat 100 rupee. Equity shares have market value because equity shares are traded on stock exchange. Preference shares do not have market value because they are not traded on stock exchange. And last, types of equity shares and types of preference shares. There are two types of equity shares with normal voting rights and differential voting rights. Preference shares, types of preference shares are cumulative, non cumulative, participating, non participating, convertible, non convertible, redeemable, irredeemable. So, types of issue of share capital or methods of issue of share capital. In case of private limited company, and public limited company. Right issue can be issued by both private and public limited company. ESOP or ESOS, employee stock option scheme, can be issued by private limited company as well as public limited company. Private placement of shares can be issued by public or private limited company, but public issue cannot be done by public limited company. Public issue of shares can only be done by public limited company. Sweat equity is provided to employees of the company, employees or worker of the company. It can be issued by private limited company as well as public limited company. Bonus issue of shares is a kind of shares which are issued by both the companies, private as well as public limited company. One point to note here is employee stock option scheme. This type of share, this type of equity share is provided to those full-time employees who are director of a company or promoters of the company, and sweat equity shares are issued to other remaining employees of the company. And the method of issue of these shares are provided in the provisions of Companies Act 2013.